Hello and welcome to this edition of The Market Share. I'm Paul Gifford, Chief Investment Officer at First Source Bank. Joining me today is Pete Cahill. Pete joined our team a couple of months ago and has 30 years investment experience and holds the Chartered Financial Analyst designation. So Pete, we're obviously seeing a lot of extremes in the market during the pandemic. And it reminds me of a quote from Ralph Shive, who used to be our Chief Investment Officer, that averages are made up of extremes. Clearly we're seeing some extremes. Let's talk about some of the extremes we're seeing in the equity markets right now.
Yeah, well, the pandemic certainly has caused some extremes, and I'd like to talk about those extremes through the example of four of the stay-at-home stocks. Netflix, Amazon, Peloton, and DraftKings were four companies that benefited greatly from the early days of the pandemic. So if we can put up the first graphic, please. This is the charts of those four stocks over the length of the pandemic. And what this chart shows is a story of something we call round trips. These stocks have all risen dramatically and have since declined back to where the pandemic started. For instance, if we take Peloton as an example, Peloton was $27 a share at the start of the pandemic. It rose to $167, a nearly six-fold increase by early 2021. And it has since declined all the way back to $18. Amazingly, all four of these securities are now trading below the levels they were at the start of the pandemic. I think these stocks speak to the core of our investment philosophy, which is that we believe consistent and long-term investment returns are the key to our clients' financial success. Slow and steady wins the race.
Yeah, and that's been more quick and short term very much in those four stocks cases. So one of the extremes we've also seen in the market is what the Federal Reserve did in response to the pandemic. So we started to see that unwind a little bit today, or in the last week, as the Federal Reserve raised 0.5% for the first time in 20 plus years. So why don't you walk us through some of the extremes in that unwinding in the fixed income markets?
Sure, because the pandemic environment, and particularly in the short term here, the bond market has been the focus of every investor. In fact, the first quarter was the toughest bond market in nearly 40 years. So if we can go to our next graphic, we'll see on this graphic that the 2-year U.S. Treasury note at its low point was 0.13%, or a quarter of an eighth of a point, which is basically zero. It's now at 2.82%. You can see also throughout various maturities on this display that the story is the same throughout bond land. Now, what's been painful is how quickly this has happened. Rates have normalized very, very fast, and the reason that they've done that is that the bond market has done what capital markets do. It's anticipated Federal Reserve rate policy, what Paul alluded to a second ago. So the experience that bond investors have been unpleasant, but we believe the normalization of interest rates is a necessary and healthy development in the fixed income markets.
No, a lot of this unwinding actually needs to occur for us to continue to grow assets going forward. So obviously when there's extremes, sometimes people think there's nothing to do. We actually have 4 or 5 strategies that we're implementing right now during these volatile and extreme times.
Yes, we do. I mean, the first thing that we've done, Paul, is we've stayed calm, and we have double-checked and triple-checked our thinking. We've also turned cautious. And we've done that by first upgrading the quality of our clients' equity portfolios by increasing our focus on steady and consistent profits. Second, we knew interest rates had to rise from zero at some point, so we've taken steps to lower our clients' interest rate risk in their fixed income portfolios. Third, the markets have been unpleasant, there is no doubt, but we've used that as an opportunity to opportunistically harvest tax losses for our clients. And finally, we've been communicating and communicating and communicating. We've been prudent, we've been deliberate, and we'll be decisive.
Those are great 4 strategies that we're implementing right now for clients. We believe that the unwinding of some of the extremes in the pandemic is going to take a little bit of time, and we're going to go through very difficult periods like we've seen over the last several days, particularly in the equity markets. As always, as Pete mentioned, we're going to do our work to make sure that your portfolios deliver on the long-term goals that you have. As always, thank you for the opportunity to serve you and your family, and have a great day.